battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome to the Nick Stenger Show Christmas special, episode 170. We are so glad that you've joined us live for this episode. And if you've been coming to the show each and every week, watching on YouTube, Apple, and Spotify, thank you so much. Thanks for being with us. Here, we're doing one thing here, and that's to give you the good news, the clarity and confidence, the reasons why you got to stay on your plan. If you haven't subscribed yet, please do so. If you're watching on YouTube later or on Spotify or on Apple Podcasts, just subscribe to the show. It helps us get it to more and more people and get them the good news, the clarity, the confidence, the math, statistics, data, the reasons why you have to stay on your plan. And as is customary with the Christmas show each year, I've got the birth of Jesus, the Christmas story, ready to read to you. So we'll jump right in. In those days, Caesar Augustus issued a decree that a census should be taken of the entire Roman world. So Joseph also went up from the town of Nazareth in Galilee to Judea, to Bethlehem, to the town of David, because he belonged to the house and the line of David. He went there to register with Mary, who was pledged to be married to him and was expecting a child. While they were there, a time came for the baby to be born, and she gave birth to her firstborn, a son. She wrapped him in cloth and placed him in a manger, because there were no guest rooms available for them in the inn. And there were shepherds living out in the fields nearby, keeping watch over the flocks at night. An angel of the Lord appeared to them, and the glory of the Lord shone around them, and they were terrified. But the angel said to them, "Do not be afraid. I bring you good news that will cause you great joy for all the people. Today in the town of David, a Savior has been born to you. He is the Messiah, the Lord. This will be a sign to you. You will find a baby wrapped in cloth and lying in a manger." Suddenly, a great company of the heavenly host appeared with the angel, praising God, saying, "Glory to God in the highest heaven, and on earth peace to those whom his favor rest." And isn't that what we try to do on the show here? Isn't that what we try to do with the clarity and confidence, is to give you the good news as you get into Christmas next week? We just first of all want to wish you a very Merry Christmas. Enjoy the time, and remember that being afraid is part of our nature. I think "do not be afraid" appears in the Bible something like over 100 times, or some huge amount like that. And that's baked into our human nature, is to be afraid. It's okay to feel fear, but like days like yesterday, where the stock market, the S&P was down almost 4% to close out the day, the NASDAQ down 4%, the S&P down 3%. These are the days where you got to have the good news. And so what we're going to do today with our 2025 market outlook is just continue to remind you of what's coming and where I see markets in 2025. If you go back, though, to the beginning of the year and really the end of 2023, when most of Wall Street and the strategists were out there putting out their targets for the S&P, saying where they thought markets were going to go, just like we do in the new year. In December of 2023, most of Wall Street was incredibly bearish. In fact, it's really easy to sit here today and have everybody say, "Oh yeah, wasn't it obvious? The S&P is up 26, 27, almost 28% for the year. Isn't that so obvious that we'd be at that point?" Well, a year ago, it wasn't obvious. There was a lot of uncertainty. We were going into an election cycle, and not to pick on Morgan Stanley, because they do have very good strategists over there and good portfolio managers who have been spot on, who have called it, who have kept people on their plan. But just to call out in particular one or two of these doom and gloom strategists, like this person on the screen, Bloomberg, reporting December 11th of 2023, why Morgan Stanley's Mike Wilson is bearish on stocks in 2024. And if you had listened to that, I don't want to beat a dead horse here and talk too much about the bears, but if you had listened to that, you would have lost a ton of money. And so that's why I point this out, because there is coming a time. You saw a small snippet of it yesterday when the market was down 3%. There is coming a time where there will be a more major, more serious correction, I think, in 2025. And all of these doom and gloomers will come out of the woodwork and tell you why this time is different or this time's the end. And so that's why you have to realize, look at their track records. Look at what they've told you for the past 15, 16 years coming out of 08 and 09, and look at how they've been wrong for over a decade now. And so that's why it's so important you understand their track records. Here were the 2024 S&P 500 price targets for this is the S&P 500. Most of the biggest firms on Wall Street said that we would lose money in stocks in 2024. These were all put out in 2023. And look at JP Morgan there. They said the S&P was going to end this year at 4,200. You had Morgan Stanley at 4,500. You had UBS at 4,850. And here we are today, and the S&P is just shy of 6,000 points. We at Stenger Family Office told you the S&P could reach 5,200 in our base case scenario. So it's not that we're going to nail the call each and every year spot on. In fact, this year we were off, but off because the market overshot our estimate. It's not that we're going to nail the prediction every year, but just to tell you directionally, you want to be bullish. If you had to pick one way to be the past 200 years of market history, and you had to flip a coin and either pick perma bearish, always being negative, always being doom and gloom, always thinking the sky is falling like Chicken Little and running for the hills, or on the opposite side, being perma bullish, always being optimistic, well, you would have wanted to be a perma bull. And so that's what the market has proven. Again, the strategists, the doom and gloomers, these people on Wall Street, remember who their target audience is. Their target audience is really not you and I. Their target audience is hedge funds. They sell a lot of their research on the equity side to hedge fund companies. And so because hedge funds, remember hedge, they want to hedge the downside. They want to come out during the big bad year like 08 and 09 and give you a better return than the S&P in these drawdown years. Because they're always hedging the downside, they tend to be bearish. And because of that, the Wall Street pundits who cater to these hedge funds tend to be bearish too. They publish bearish research. And so you have to know where they're coming from. One of the hedge fund people, and I don't mean to pick on anybody, but this is Michael Burry. Michael Burry tweeted in January 31st of 2023, one word on his Twitter page, and that's sell. Remember, Michael Burry is the famous hedge fund guy who called 08 and 09. In fact, he was so right. He was so spot on. They made a Netflix movie on him. It's called The Big Short. Some of you have watched it. And so because of that one call, he's paraded out as a hero. Well, if you looked at his predictions the past 15, 16 years after 08 and 09, and he's been bearish, well, what's happened? Well, he's been wrong. And ever since this tweet in particular came out at the beginning of January 2023, the S&P has gone up 52%. So just be careful who you're listening to. Be careful who you're watching. Be careful what you're consuming. We did the episode a couple weeks ago. We called it garbage in, garbage out. And if all you're doing is consuming garbage, in my opinion, like this, you are going to make some bad decisions in your portfolio. And so what we've told you, we showed this to you last year on the show, this great quote, that bears sound smart. And even a lot of them are smart. They're very intellectual people. They sound really good. They have really good arguments. They go on CNBC. They go on Fox Business, and they tell you in a very, very good sounding argument why the world is coming to an end. Bears sound smart. But you got to remember, in the end, bulls will make you money over time. And so if you go and you watch CNBC or you watch Fox Business, which a little bit of that is okay, who you want to listen to are people who actually have to allocate capital. So there's a difference out there of the people who are strategists, traders, and timers, the people that don't have any responsibility to actually produce results for clients. They have no track record. They have no report card that they have to show people. They can say whatever they want. They can go out on CNBC on Monday and be bullish, and by Friday be bearish. Well, if you're actually managing an equity portfolio, you can't do that. You have investors, and your investors, your clients, will leave over time if you get it wrong consistently. So if you're an equity portfolio manager, what are you? You're a bullish person. And if you watch these people who actually do manage money, they've been bullish. Why have they been bullish? Well, it's because of this. And if you look at this chart in front of you on the screen, I hope you can see it. I know it's a little small. This is a a chart of the S&P 500 going back pre-financial crisis all the way back. I believe this one starts in 2004. So this is now 20 years of history. And we like to say at Stenger Family Office that markets, especially the S&P 500, climb a wall of worry. And look at all the bad stuff that's happened. Well, in October of 2007, right before the big crash, the S&P 500 traded at 1,552 points. We all remember 08 and 09. Remember, your 401k became a 201k. The market literally dropped 60% in like 8 months. It was a bloodbath. And then the government came out and reversed mark-to-market accounting, and finally things started to pick back up again, and we did have a recovery. And if you had sold out at the bottom of 08 and 09, you would have now missed out on an 863% return in stocks. One of the best times ever to be a holder of equities. Back in 07 and 08, the Stenger Group had clients who did drop out, about 2 or 3 out of about 1,000 at the time, so not a huge percentage of the overall client base. And guess what? Those people never, ever got back in. Why? Because what they do is they look at this chart, they say, well, things are only going to get worse, so I made the right decision. And in the short term, they might be right. The market goes down a little bit more. And then what happens? Then we finally come back a little bit. You saw that initial pop into 2010. And literally what the bears did, like clockwork, could not be more predictable, came out and said, no, don't get into this market. This is a dead cat bounce. In fact, we're going to have a double dip recession. We're going to go back into the abyss of 08 and 09. And so those people say, no, I'm good. I'll hold my treasuries. I'll hold my cash. So they miss out on that recovery. And then they see these prices in 2011 and 2012, and the S&P finally produces total returns that would have matched where they would have been even if they bought in at the worst part of 07 and 08 at the peak. They would have made their money back by 2012. And guess what? They say, no, I can't get in now. Now the market's too high. And they go through all these different reasons why they can't get in. In 2016, remember Trump 1.0, we had Brexit when the S&P traded at 2110. And they say it's too high now. There's no way I can possibly get back in. So they stay in cash. Then they have COVID. We all remember COVID like it was yesterday when the S&P peaked out at 3390. We had a 30% drop in 2 weeks in the stock market in March of 2020. And these people say, oh, see, I told you, market's volatile. There's no way I could possibly get in. But in reality, if they did some basic math, remember I tell you, look at the data, look at the math, look at the statistics. They say, nah, I'm better off in cash. Well, the reality is they still, even after the COVID crash, would have been better off just sticking to their plan, staying in the market. The markets climb a wall of worry. And the last thing that's most recently happened, outside of some geopolitical that we all know about, is the Fed started hiking rates. And so when the S&P peaked out at 4750 in December of 2021, then the Fed started raising interest rates. And if you listen to the bearish strategists, if you listen to the pundits, what they would have told you is this is the end. They would have said the end is near. The Fed is hiking rates. The era of free money of 0% interest rates is over, and we are never, ever going to recover. And then what did the stock market do? It took a 22% dive. It went down. It corrected in 2022. Why? Because we actually had a technical recession that summer. Nobody talked about it. It was a midterm year, so nobody wanted to bring it up. We had a technical recession in the summer of 2022, and the market, because it's a forward-looking indicator of what's to come, said we're in recession and priced that in ahead of time. And then we got past that mini flash recession of 2022, and we're now pricing in, especially starting in January of 2023, a recovery. And I believe we are in the early parts of an economic recovery, which we'll talk about in just 1 second. But if you looked at these Fed rate hikes and you said, oh, the end is near, the Fed is hiking rates, equities can never sustain the level that they're at today, you would have missed one really important thing. And that's the fact that you were using your old playbook from the last time we hiked rates. Remember the last time we hiked rates? It was under Ronald Reagan in the 1980s. We came off of the LBJ big spending years, big government, great society spending, where we had printed 40% more money into the economy. Sounds a little familiar, right? We did the same thing under President Trump and President Biden this year, okay, and last year and the year before. We printed 40% more dollars into existence. Well, when Arthur Burns was Fed chair in the 70s, he raised rates initially, but he got kind of weak knees. He just buckled a little bit, and he really just wanted to go down loved. And at the time, he was. Arthur Burns went down in the history books initially as the best Fed chair ever because he cut interest rates, and then he retired and he left and packed his bags and left. Well, guess what? Inflation didn't go away. And so when Paul Volcker came in I think it was either 1980, don't quote me on this, it was either 79 or 80, as the new Fed chair, he dealt with the resurgence of inflationary pressure. And so what he did to combat that was he raised interest rates to 19%. If you remember that time, or you had parents at that time or grandparents at that time who had a mortgage, they were paying 23% on their mortgage. They were getting 20% on their CDs. And you would have thought that the following 8 years under Reagan would have been a bloodbath in the equity markets. Well, that's just not the case. And in fact, under Ronald Reagan, equities posted 8 of the best years they've ever had. I'm not making a political statement. So if you hate Ronald Reagan or you love Ronald Reagan, please don't get your politics mixed into what I'm about to tell you. Because what really mattered was not politics in the 80s. What mattered was policy. And if you remember Reagan standing there in the Oval Office with the stack of regulations saying, we're going to shrink the size of rules. We're going to bring down the deficit. We are going to cut taxes, for example. What happened under Reagan is we unleashed a wave of American prosperity like we've never seen. Now, it's not just a red president. It's also been carried out sometimes under blue presidents. And you just have to look at Bill Clinton in the 90s, who took a lot of the same playbook that Reagan used. And what did he do? He cut taxes. And so even under Obama, we didn't raise the corporate tax. So it's not like we cut taxes under President Obama, but we didn't raise the corporate tax rate, and equities still did well. So what I think we're set up for now, and I think where we're going, is we are going to see further tax cuts. We're definitely not going to see tax hikes. I think we're going to see persistent inflation like we did in the 80s, but because of good policy coming, which we will cover in a few slides from now, I think equities are poised to have some of the best years we've ever seen. So how do we think, why do we think that, and what's the math behind the market? I've shown you this formula. If you came to Investor Day, you have heard this so many times. You are so sick of hearing it. You're like, Nick, can't we just move on from this math equation? No, we have to do it one more time, and it's a very basic one. Earnings, E times price, P. E times P equals what? The stock market level. So here we are today, just shy of 6,000 points on the S&P. Why is it that we can trade the market at 6,000? Now, I should have updated this morning with the market down yesterday. So this is just one day old. But what I want to do is show you why the S&P could possibly trade at the level it does today and not be a fugazi, woozy-wazi like Wolf of Wall Street. It's simply because the market is a forward-looking indicator of the future. So why do we care about 2025 profits? Why do we care about next year? Because Wall Street doesn't care about what happened last quarter or this current quarter. What do we care about? Well, it's accounting 101. It's the going concern. Are you going to be around in a year? Are you going to be around in 5 years and 10 years? And what are those profits going to look like? What are those discounted cash flows worth today? It's just math. It's just basic accounting. And because we're looking at 2025 profits, taking the S&P at 6,000 points, multiplying the expectation of 275 in earnings, E, for 2025 by the current price of 22 on a forward basis, you can easily trade the S&P at 6,000. So the big question that you're wondering, and everybody's asking now, rightfully so, is, Nick, is 22 the right price to pay for those $275 in earnings? Now, if you listen to the doom and gloomers and the bears, they're going to tell you that everything's going to fall apart. They're going to tell you E is going to go down, E is not going to be 275, and they're going to tell you the 22 is not the right price to put on those earnings. I'm going to tell you today, I think 22 is a little bit higher than probably where we've been in the past, but I'm going to tell you why that's sustainable. But more importantly, I'm going to tell you why I think the E is not out of the question, why that 275 is not to be doubted. And part of it is because innovation is just at continuing at a rapid pace. Just when you thought NVIDIA couldn't do anything else and couldn't innovate anymore, they come out now with a $250 computer where you can run your AI, your artificial intelligence, and quantum computing on this little computer, and you can bypass all the other providers that you used to have to go through. Just when you thought, now you may hate Elon Musk, you may love Elon Musk. Remember, half the country hated Elon Musk 4 years ago. Now the other half of the country loves Elon Musk. Put your politics aside and just look at the innovation. I mean, it's just so cool. It's incredible what's going on. And so just when you thought Elon Musk couldn't do anything else, he changes the entire Tesla business into a subscription model where the cars are literally robots and will drive you anywhere you want to go. And I had a client who just got in one of these, and he goes, Nick, this is the coolest thing. We went from Los Angeles all the way down to San Diego. We did a road trip, and that's a couple-hour trip. He goes, filmed the whole thing. It was incredible. Nobody touched the wheel the entire 2 hours we're in the car. So if you don't see why that's so important, if you don't understand why that's so neat, you got to get yourself some of these science journals. You got to get yourself exposed to what's really going on, because technology is driving E. Management teams are driving E. We have many employees at large Fortune 500 companies. Remember, these companies are run by people just like you and I. And they go to work every single day and say, hey, how do we make this better? How do we increase our E? How do we reduce our expenses? How do we make sure our business is viable 10, 15, 20 years down the road? That's what you're investing in when you're in the S&P, the best and brightest. And so that E, I think, is in good shape for the long run. We're going to talk about the P and then the 22 in a second, but don't doubt the E. Don't doubt American innovation. When we look back at 2024, here's what worked really well in this year so far. The Mag 7, these companies, Netflix, Apple, Amazon, Facebook, Google, all the biggest and best. NVIDIA now up 79% in 2024. And then you say, hey, what else is working? You go down south to our friends, the Argentinians, and they are up 74% for the year. You're like, whoa, what happened down there? Simple answer, you may love him or hate him, but Javier Milei, he comes into Argentina. He says, what? We're going to the big whiteboard there. We are going to take all the government agencies and we're going to go, you're gone, you're gone, you're gone, you're gone, you're gone. We're going to take inflation down from 40% down to 3%. And they did. And they did it in like 18 months. And so anybody who tells you can't have a balanced budget, anybody who tells you can't get to surpluses in Washington is wrong. They're probably working for the federal government. And look, we have federal government employees as clients. We love you. We think you're awesome. You're great people. We're not saying anything about that. But what happens is when the federal government becomes too big a piece of our spending, it slows down innovation. It slows down the pace at which we create wealth. And so if you are a proponent of entrepreneurs and you're a proponent of, you don't want crony capitalism, you don't want monopolies, you want people to innovate, you want to lift people out of poverty, you want to have more people have the freedom of speech and democracy, well, you got to be a pro-capitalist, pro-entrepreneurial person. You just have to be. And if you're going to be that, if you're going to be pro-entrepreneur, you also have to be smaller government-based. We have to have a government. Government's ordained by God. We have to have rules. We have to have laws. We have to have red tape, and we have to have stop signs. But when those get too burdensome on small businesses in particular, what happens is innovation slows down. I've shared the story of the local restaurants here. We have clients who run restaurants and gyms and retail stores. And they say, Nick, I've got 6 or 7 different sets of rules I got to manage through or hire compliance people and attorneys just to run my little store that does $500,000 in revenue. Maybe in a good year, you make a $90,000 profit. It's just ridiculous. We've got to get entrepreneurs growing. And that's what Argentina did. There's no surprise why their stock market did what it did this year. By the way, it's up 235% the past 5 years. So if you thought the 2024 number was good, markets love freedom. They love when you help entrepreneurs. Now, the S&P, this number is just a few days old, but was up 28%. I still think we're going to end up right around there for 2024, just a couple weeks left. The MSCI China actually up only 17% now today, had a rebound year on the back of only stimulus. So remember, we've told you, watch out for China, watch out for the companies over there. You don't really have good data. You don't know what President Xi is going to do. Maybe he's going to lock Jack Ma in prison again. And so you got to be careful with Chinese equities. The only reason you saw a rally this year is because they said, hey, we're in such big trouble, we got to pump stimulus into the economy. Well, you look at that 5-year Chinese number, they're down 33, 34% still. Be careful. I've been warning you. The S&P 400, that's mid caps. Russell 2000 is small caps. You've seen a lag there. Why? Because of business quality. As the financing costs go up, the small and the mids struggle. So you're seeing some lagging performance there. But at the same time, hey, 17, 18% for 2024, that's not bad. That's a pretty good return. Now, on the back end, what's at the bottom there? MSCI Europe. That's the European stock market. Developed Europe. Europe is up 4% for the year, which is literally lower than a 30-day treasury. You're thinking to yourself, what went wrong in Europe? Well, in Europe, they don't innovate. In Europe, they don't have a ton of companies that can rival the Mag 7. And I'm not talking, look, our family's German, okay? We love the Germans, the nation of engineers. They're great. But at the same time, current policy has made a lot of these entrepreneurs in Europe leave Europe and come to the United States, come to Silicon Valley, come to Texas, come to New York City, and create their businesses in the United States rather than in Europe. Why? Because Europe has regulated everyone to death. They've regulated out innovation. And so where are you seeing the innovation? Right here on our soil, where we have all the smartest Chinese people here. We have all the smartest Japanese. We have all the smartest Latin Americans. We have the smartest Africans. They've all come together and they've gathered under our roof. You've got the best and brightest right here in the United States on our soil. Let's talk a few stocks. You've heard this narrative all year. Nick, it's only 7 stocks driving the market. There's only 7 companies that are doing anything, to which I say, have you looked at the data? Because GE Aerospace is one of the top performers in the S&P, up 63% for the year. American Express, nothing to do with AI, up 61%. How about Progressive Insurance? The auto and home insurance up 56%. Cummins diesel engines, pretty sure has nothing to do with AI, up 51%. Bank of New York Mellon could not be the most boring. It could not be more boring. Okay, Bank of New York Mellon has got to be probably the most boring company in the S&P, up 51% for 2024. Costco. If you sold Costco 5 years, you are regretting it like crazy. I'm like, sell Costco. You got to be out of your mind. I went to Costco this weekend. You can't get a parking spot. You can't get in the store. You can't move your cart when you're in there. Costco's up 49%. PayPal up 48%. CBRE, which, by the way, sells office real estate, okay? CBRE selling office real estate, leasing it, up 46% for the year. Booking Holdings, people traveling, going on trips, all the baby boomers that stayed home for the past 3-4 years and didn't go on their cruises. They're back. They're going on their trips. General Motors, you thought that company was done for, up 42% for the year. I'm not recommending you go buy any of these. I'm just showing you as an example. It's not just 7 stocks. Then you've heard the narrative. You say, Nick, the consumer's weakening. They've got to run out of cash at some point. People are slowing down. And if you listen to Walgreens, if you listen to Foot Locker, if you look at Ford, if you look at Macy's, if you look at Target, you might start to believe that that's true. If you listen to these, I've listened to some of them, but Target on their earnings call say, oh, the sky is falling. The world is coming to an end. The consumer is tightening up and slowing down, and they're just not spending. And then I say, well, wait a second. I look at the data. I look at the numbers. I say, if that's true, how is Williams-Sonoma, which is selling a more premium product than Target, up 95% for 2024? By the way, not an AI stock. Walmart, up 80%. Amazon, up 54%. We talked Costco's up 49%. Restoration Hardware, selling high-end furniture, up 44%. So What's happened in the economy? Consumers, like always, are chasing value. Consumers are chasing better products, better services. And if you don't deliver that, your stock goes down. Your company doesn't do well. I was in Walgreens the other day. We ran out of something. I had to go. There was nothing else open. I go to Walgreens. I go through all the aisles. They don't have it. So what do? I pull up my phone. I go on Amazon, and I'm literally standing in a Walgreens ordering it from Amazon. Okay? That's Walgreens' own fault. I'm sorry to tell you, we love Walgreens, great company. It used to be a great place. It used to be the NVIDIA of its day, by the way, up 20% a year for 20 years. But they just failed to innovate. They failed to keep up with the trends. So that's why Walgreens is down, Amazon's up. Here's my bull case for 2025. Number one, you get pro-business policies from DC, meaning less regulation. You get less taxes. You get the government to shrink in size just a bit, not go away, but just shrink in size a little bit. And by the way, I think something we can all agree on is term limits. If you're on the left, if you're on the right, you're looking at Chuck Schumer, you're looking at Nancy Pelosi, you're looking at Mitch McConnell, and you're going, guys, okay, I'm not maybe the best at math, but I've got a calculator here, and you made $200,000 for 30 years, and somehow you're worth $150 million. The math doesn't add up. Something's off. Okay. So whether you're on the left or whether you're on the right, something I think we can all get behind is we got to limit these people. It's not supposed to be a career. They're not supposed to be able to go to China and get rich off of being in office. So we've got to get the size of government. We've got to get term limits. We've got to get common sense in DC. And one of the bright spots here is Doge. Again, you may not like these people, so I understand that. But I just want to give you an example. Vivek Ramaswamy and Elon Musk are partnering together, and they're going to have a Department of Government Efficiency, and they're going to go through and they're going to say, where are we wasting money? Maybe we should have some term limits. Maybe we should have some checks and balances in Congress. And I think that's a very good thing for markets. And by the way, if you don't believe me, go back to the slide with Argentina. It's worked down there. Number two, companies will produce strong profits. I think companies are going to do better than expected. I went back through some of the earnings expectations when we were in 2021 for 2022, and then 2022 for 23 and 23 for 24. If you look at all these earnings expectations that were put out by those same Wall Street pundits, they said earnings aren't going to be very good. They said 21 is going to be bad, 22 is going to be bad, 23 is going to be bad, 24 is going to be bad. I said, well, wait a second. What'd they do halfway through the year when earnings were better than expected? They quietly revised their estimates up and pretended like it never happened. And I'm like, well, I've got my doom and gloom folder. You remember this? I've got a folder where every time I see a doom and gloom story, I print it out so I can talk about it later and remind you that you got the call wrong. I know that you changed your estimates. I know halfway through the year you revised up. And I think that's what's coming again in 2024. I think we're going to see earnings revisions to the upside. And then number three, and this is may sound a little bit counterintuitive, is the fact that I think we're going to have persistent inflation, but at the same time, equities will outperform. And so one of the things that I think you're going to see is just like in the 80s when we had high inflation, at the same time, I think equities are going to do better than the bond market. And so be on bonds. This is my one warning is be careful what kind of stuff you're investing in. And if you're in long-term bonds in particular, be careful. If you look at the 20-year Treasury today, I pulled it up this morning. I can pull up the most recent number as we're talking right now. The 20-year Treasury is down 1.5% today. It's down 11%, 12 months on the 12-month return. The past 5 years on the 20-year Treasury, we were down 35% price return. So be careful what you're in. Make sure, in my opinion, that you are watching the duration in your bond portfolio. We've kept you at 30-day duration. So what could make me bearish? And you're thinking, Nick, there's nothing that could make you bearish. You're just a perma bull. You're always bullish. And that worries me. I had one of my clients the other week say, Nick, the only thing is that worries me is that you guys are just so optimistic. And I wanted to say to him, hey, you worry me because you're always bearish. You're always pessimistic. And so again, I say I'm not always bullish. It's just based off of the data that we're seeing. And so the data that we're seeing that could make us bearish eventually is if you have this rising valuations. If you continue to see the P and the P ratio, the price that you pay for stocks go up, but you don't have earnings go up, you have stagnating earnings and you have rising price, that's what could make me bearish. Now, let's look at the 90s and let's study that, because everybody wants to compare today to the late 90s and early 2000s. In 1991, we were trading the S&P at 15 times earnings. That's that left-hand column there, S&P 500 PE, price to earnings ratio. We traded for about 15 times earnings. The stock market posted a 30% return in 1991. It was undervalued. Then in 1992, we jumped up to 25, almost 26 times earnings, and the stock market still returned in 1992 an 8% return. In 1993, we dropped down a little bit. Stocks became a little bit more undervalued, and we traded at 22, which is roughly where we're trading today, and the stock market posted a double-digit 10% return. In 94, you traded about the same, not a whole lot of price momentum, and we had a 1% return. And then all of a sudden what happened was earnings went way up. A lot of the technology helped these companies become more profitable. And S&P earnings skyrocketed in 95, 96, 97. You traded the S&P at 14, 15 times, then 18 times in 96, just under 20 times in 97. And as a result, you had 4 back-to-back years from 95 to 98 of just incredible equity returns. Look at 1995, 37% return in the S&P. 96, we had 23%. Then in 97, we had 33%. In 98, we had 28%. And then right before the bubble started to burst in 1999, we posted a 21% return. So it wasn't until you got to 2000 that you traded the S&P at really a ridiculous multiple. I would argue 1999 was somewhat of a ridiculous multiple at 33, and 2000 was certainly crazy at 41 times earnings. But remember, the bubble didn't all burst at once. And so a common misconception is that you just had a 60% decline all in the same year. That's not the case. In fact, if you were to expand this chart out to 2001 and 2002 and 2003, the bubble burst slowly over time. It went down the market went down 9% in 2000. We went down double digits in 2001, and I believe again double digits in 2002, pricing this in. But that's the S&P overall. If you actually divided the S&P out by value stocks to growth stocks, so high multiple 100, 200 times earnings growth stocks to value stocks at more reasonable 15, 18, 20 times earnings levels, the value stocks actually did okay in 2000 and 2001 and 2 and 3 and 4. So you just have to understand, when people talk about the 90s, they forget to mention that the years leading up to the 90s were actually incredible years. And I think today is very similar to where we would have been in 1991. I think we're in the early innings. I think we're in the early stages of growth. Now, what could change that? Well, if you continue to see the price multiple go up, we're trading right now at 22 forward. If you see that go up to 25 and then 30 and 35, then there's never any big pullbacks and there's never any big earnings growth. I would be concerned. And I will tell you, I'll tell you what I think when we get there, but we're not there yet. I still think we're in the early innings of what could be, again, one of the best times to be a holder of equities. Now, what are some of the risks to watch out for in 2025? Number one is anti-China sentiment and trade policy. If you're buying Chinese stocks right now, I think you're absolutely insane. And this is my personal opinion, so don't go trade on this. Don't go change anything in your portfolio because I said something on a podcast. I'm just telling you, when you look at the data, I think you've got some serious risks in China. Trump 1.0 is not good for China, and I think Trump 2.0 is going to be worse. And so just be careful with some of those equities. Number two, stagnating growth in Europe and Japan. Japan is kind of a mess. Europe is definitely a mess. One of the problems is they don't have population growth. If you can't have babies, if people aren't having kids, one of the problems is you don't have anybody to grow your economy long term. And especially as your baby boomer population ages and more people retire, you don't have anyone to come in and pay for those benefits. And so, yes, we've got a little bit of a slowdown in the birth rate in the United States, but one of the positives has been immigration. And so if you have good legal immigration, you bring people in, which, by the way, the immigration policies in our country are completely backwards. We let people in with no credentials. And then I've got clients who work at Fortune 500 companies who have been standing in line for years to get their citizenship, and they can't get it. I mean, it's so bonkers. It's so ridiculous. It's so backwards. So if we can fix our immigration, if we can still get people into our country who are qualified, who are great people, who are working at these places and innovating, that's the best thing possible. That's how we're going to continue to outpace Europe and Japan. But I think Europe and Japan are going to have a problem. So last but not least, I think what you're going to see with the Fed, you saw that meeting yesterday where they cut a quarter point. I think you're going to continue to see some rate cuts. Nothing crazy, nothing to write home about. But you may think to yourself, Nick, rate cuts are good, right? I'll see my mortgage fall eventually. I'll be able to finance stuff again. I'll be able to refinance my debt. And these rate cuts have to be good. Well, they're good for small caps and mid caps in the short term because the small and mids, they borrow off of that usually overnight lending plus some sort of a spread. They call it SOFR now. And so that might be true for lending for companies. But I think on the back end, just be aware of the fact that even if the Fed cuts and we avoid recession, which if you want to listen to Powell or not, he came out yesterday and said the economy is in pretty darn good shape. He thinks we're going to avoid recession. Well, if that's true, then long-term yields could easily keep climbing. And I've been pounding the table on this each and every week saying, watch out, yields could easily hit 5%. We're here today, 10-year treasuries 4.5%, and I think that's in the cards. So just be careful with those long-term bonds. So number 4, some tech stocks, be paying attention, be careful, watch what you're owning. Because if you're in everything, if you're in all the tech stocks, if you're buying the growth index, just be aware of the fact that a lot of these tech companies are overvalued. And I told you, I promised I'd tell you when I thought things were expensive. There's a lot of tech companies out there I have my doubts on. I'm not going to name individual names, but I have some concerns about part of the market, which is why we've kept you balanced. We've had value stocks in the portfolio. We've had dividend payers, dividend growers, and we have had growth, but we've balanced those two off of each other. So let's wrap up with just a couple of last slides. One of them being, are stocks overvalued today? So you're going back to that equation, earnings times price, and we said today's forward-looking multiple on the S&P is 22. Is that too much? Well, let's break down the past couple years by earnings, what the S&P is traded at from a price to earnings ratio standpoint, and then something that's very important that goes overlooked, which is earnings yield, where you take the earnings on the S&P and then divide it by the price of the S&P, the level of the S&P, and then compare that to the last column, which is the 10-year Treasury yield. In my opinion, and it's not just my opinion, but we had Dr. Jeremy Siegel from the Wharton School, Stocks for the Long Run, on our podcast. If you haven't watched the episode, make sure you watch it. It was our best episode of the year. And he says that earnings yield, as long as it's higher than the 10-year Treasury, makes the market a good value. And so if you go back to 2019 and you took the S&P's earnings at $162, you were buying the S&P at just under 20 times earnings. These are current price earnings ratios, not forward. Then you took the earnings yield of that 162, you divided it by the S&P's level at that time, and the earnings yield was 5%. That was one of the best times to buy equities. And in fact, we were putting out shows back then, we were writing articles, and we were saying, buy like it's going out of style, buy like there's no tomorrow, because stocks are cheap. And they were. The 10-year Treasury was only 1.9%. And then in 2020, remember we had our COVID crash. S&P earnings did drop. They dropped to $138. You were trading the S&P at 24, almost 25 times earnings. And earnings yield was still higher than the 10-year Treasury. And so, yes, we had that major correction in March of 2020 where the stocks dropped 20%, 30%. But because the 10-year Treasury had also dropped, we posted a 20% return for 2020. Absolutely incredible. Anyone who panicked in 2020 lived to regret it. Then in 2021, stocks got more expensive, and stocks got to the point where we were trading the S&P at 36 times earnings. We told you there's a correction coming. We didn't know when it was going to happen. I do have the crystal ball here sitting on the table in front of me. We didn't know exactly when the correction would happen, but we said, watch out, there's one coming. And sure enough, it did. And so in 2022, we gave some of that return back. 2019 was a unbelievable year in the market. 2020 was an unbelievable year. 21 was unbelievable, got a little bit ahead of itself. So in 2022, when we had that 20% correction, it really wasn't that surprising. But by the time the market had bottomed, by the time the correction had worked its way through the system, you were now paying 23 times earnings for stocks, which is a little bit higher than historical. But look at the difference with that earnings yield. Earnings yield on the S&P in 2022 was 5.7%, meaning that stocks, relatively speaking, were more undervalued. They were less pricey than they were in 2019, making them a better buy than they were in 2019. And so you went out and you bought stocks. We produced episode after episode, show after show, saying buy, 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 buy. Don't wait. Just get your money in the market now. And you did. And you're happy you did, because 2023 was another melt your face off unbelievable year. We traded the S&P at 22 times earnings. We had an earnings yield just slightly over, about 1% over the 10-year treasury. Stocks were still undervalued. And then we rolled into 2024 with estimates right around 241 in profit. That's where we ended up this year, is where our expectations are at. And we're trading the S&P a little bit pricier than we did 2 years ago. But you have to remember, we're trading stocks now at roughly the same price we traded them at in COVID during 2020. And if you look at that earnings yield of 4.1%, it's not lower than the 10-year treasury is today. The 10-year treasury is ticking up to 4.4, 4.5%. But remember what I always tell you, the stock market isn't looking backward, it's looking forward. And so the stock market today is telling you two things. One, we think earnings are going to be higher. That's that 275 estimate that we have on the S&P for next year. Number two, we think treasuries are going to normalize. Maybe they don't fall as much as people think, but we don't think they're going to rise dramatically out of whack. Yeah, maybe we hit 5% on the high end on the 10-year treasury, but it's possible we just tread water. And because of that, the earnings yield on the S&P is still higher than the 10-year treasury. And I think by the end of next year, you're trading the S&P right around 20, 21, maybe 22 times earnings. To me, that's not radically overvalued. And so when we look at where we're headed for 2025, what are we going to do? We don't care about this year's profit. We don't really even care about 2025, next year's profits. We care about 2026. And if you look at the best pundits on Wall Street, if you look at the best analysts, people like Dr. Ed Yardeni, who we had at Investor Day, who was the highest estimate going into 2024, he thinks that earnings for 2026 are going to come in at 320. If you use that 20 to 21, maybe even 22 multiple on the high end, you are trading the S&P at right around 67.20. And so that's my estimate for the next 12 months. I think we are going to trade the S&P higher 12 months from today than we do right now. That correction yesterday also made the market more valuable, more of a buying opportunity than it was 2 days ago. And so if you're coming in today buying the S&P at 5,900 and you're on a long-term investment plan, you're saying, hey, 5,900 is an unbelievable deal for something that might eventually over the next 12 to 18 months get to 6,700. Now, maybe I'm wrong on my timing. Maybe I'm off on exactly when we hit that. But I think we're not that far away from about a 13, 14% total return when you add in the dividend on the market. And so I would just tell you, stay bullish, stay optimistic. I'm going to be a little bit lower than Dr. Ed. Dr. Ed says 7,000 on the S&P. Tom Lee has said 10,000. So not by the end of next year, but by the end of the decade. So we'll see. I hope they're right. I'm maybe not quite as bullish as that, but I'm still bullish on the market. So stay invested. Here's a few last takeaways for you, and then we will wrap up. I'm sorry we're a little over time today. Thank you for sticking with us. Number one, we are due for a correction. There's no question about it. It's not a matter of if we have a correction. It's a matter of when. And when you get to the point where the S&P is at 22, 23 times earnings, in the short term, little jolts in the market can spook investors. Don't be surprised if you hand back 10%. And by the way, we have a 10% correction on average at least once a year. So if we go from 6,000 to 5,500 on the S&P, somewhere in there, don't be alarmed. Don't panic. Don't freak out. Don't jump off your long-term plan. Stay invested and use it as a buying opportunity. If you're especially in your 40s or 50s or even 60s and you're getting ready for the next 5, 10, 15 years before you retire, that's the best thing that can happen to you is a correction. Why? Because you're going to come in and buy stocks on the cheap. Number two, don't try and time the market. Remember Peter Lynch, who said, more money has been lost preparing for corrections than in the actual correction itself. You cannot try to time this. You can't trade it. You can't try and figure out when to get in and when to get out. It's not going to work. And you know how I know that? Well, there's literally hedge funds on Wall Street with 200 Harvard grads with PhDs working for them that can't beat the market themselves. They can't trade it. They can't time it. What makes you think that you in Naperville, Illinois here with your iPhone, you're going to be able to outsmart that? You're not. There's just no way. You are not going to be able to trade the market. So what you instead want to do, and this is my last point to you before we go, is to stay on a goals-based plan, not a risk-based plan. And so that's the big key to being successful as an investor. A lot of advisors, a lot of places, when you go and you want to set up an account or get invested with them, they're going to put you through a risk tolerance questionnaire. They're going to say, how much risk can you accept? If the market goes down this much, are you okay with it? And what happens is those surveys don't really tell us anything. Why? Because when the market's high like it is today, and you ask people how they feel about risk, all they tell you is, oh, I love risk. Give me Bitcoin. Give me Dogecoin. Give me meme stocks. Nothing can go wrong. I don't need any emergency reserves. And then all of a sudden, the market does go down and we're in a correction. And you ask those same exact people, well, how do you feel about risk now? And what do they say? They say, oh, I hate risk. Build me a bunker in my backyard, fill it with canned food and gold. I don't want anything to do with stocks. Just put me in treasuries. And that's not the right decision either. Instead, what you need is a goals-based plan that says, what are you trying to accomplish? Are you trying to make sure your money doesn't run out while you're still alive? Resounding yes. Are you trying to retire at some point? Resounding yes. And so as long as we start to put the framework together of a goals-based financial plan where we've got your short-term needs for the next few years set aside in treasuries, cash, high-quality investments that aren't going to go down when the market goes down, then you can take every other dollar in your plan, put it in the market, and rest easy and know that you're going to be okay over the long run. So that's my message to you is stay on your plan, stay bullish, stay optimistic, don't panic. You got to do it on a plan. You got to do it on a goals-based analysis of where you're going. But once you do that, you're set. Your future is secure. And so that's the message of the Christmas story. As you go into Christmas with your family, remember the reason for the season. Remember, do not be afraid. Let not your heart be troubled. And that's what we try to do on these shows is just to keep you grounded in the reality of all the exciting stuff going on behind the scenes. Thank you for being with us. Episode 170. We'll be back next week for a Christmas show, one last Christmas show to wrap up the year, episode 171. Thanks for being with us and have a very Merry Christmas.